Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running, and I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great.
Well, welcome to the chase. I'm your host, Chris McAlpin, and today I have my good friend Jay Coulter with me. And Jay is the podcaster with the Resilient Advisor. He has taken a unique tour through the industry, so he always has these great perspectives on things in marketing, on things in communicating with clients, on topics in the markets, topics in the economy, really seeing the world the way a lot of different advisors see the world. So I always enjoy having him on the show. We always have a good time. His wife's name's Chris, so it gets kind of confusing at times when we're talking about his Chris or me. I go by McAlpin. I guess we may, so if he calls me McAlpin, as we're talking about today, it's me. But in this show, as we're kicking off the 2022, we're going to have a couple of episodes where we talk about the markets, we talk about the economy, and a big question that I want Jay to dive in on is how should you think about this year? How should you prepare for this year? Because it all comes back to your discipline and your behavior, your financial plans, so that you're reaching your goals. Are you being successful, reaching the standards that you want to reach, or reaching the standards, quite frankly, that God has in store for you? So without further ado, Jay, welcome to the show, my friend. How are you?
Chris, thanks so much for having me on your show. Congratulations on the success of the chase. You guys just finished your first year, and you guys are really reaching a wide audience now. Are you happy you're a podcaster now?
Am I happy I'm a podcaster? I like to talk. I like to teach. And so am I happy I'm a podcaster? Yes. This was, I think coming out of COVID, the weirdest part of it, honestly, was looking at a camera, talking to a microphone when there's nobody in the room. And you're having this conversation with another person, and you're building this relationship or expanding on a relationship you already have, and you're in an empty room all by yourself. It's kind of weird. Once you get used to it, and you're just doing your best to connect to the people that you're speaking to. So yes, I'm happy that I'm a podcaster. Are you happy you're a podcaster? You do this a lot. I mean,
well, I am.
Shows now?
Yeah. So we're over 300 shows across our different brands, but I got to tell you, most podcasts fail after their 7th episode. You know, you made it past the first year, you're building an audience, you're serving people with your message. And I think you're finding a lot of fun in doing it as well. So congratulations on all the success of the chase.
You know, the funny thing is, you told me that about the 7 episodes. Somebody else told me, said you won't figure out what you're doing until you've hit your 40th episode. And we're around number 30, I think. And I think they're right. I remember when they told me that 40 episodes, I thought, no way, we'll have this figured out way before then. And no, I believe that, in fact, you and I have discussed even tweaks and changes we're going to make to the show that will happen over the next 10 episodes. In fact, this is one good time to do a teaser. We're going to talk about behavioral finance in the shows to come, and you're going to be a big part of that, because I want to hear your insight. I think that our audience needs to hear from you. So you'll be a big help.
Yep.
So
it'll
here you
be
go.
A lot of fun.
Rapid fire. Talk about markets, economy, financial planning. But 2022, how do you see the market shaking out?
All right. So if I could set the stage just a little bit here. In my business, I work with financial advisors, teams, and firms, and I help them with several different things through a consulting relationships. You know, one of them is building out their investment process and their investment strategies, and then how they communicate them to clients. One thing that we always try to do is stay away from predictions. And I want to tell you a story. It's the late 1980s. I'm living in Philadelphia. I'm in high school. And the Philadelphia 76ers are having some renovations done to their facilities. So they are practicing at our high school. And I don't know this at the time, but I go walking my happy self into the gym at 15 years old. And there is the future NBA Hall of Famer, the round mound of rebound himself, Charles Barkley, warming up before anybody else gets to practice. And because I was 15, I didn't know any different. I just walked on into the gym and started shooting baskets with him. And so after a little while, I threw him a ball and we started playing a little bit of one-on-one. So there's 15-year-old Jay playing the round mound to rebound. And as you might imagine, he beat me pretty good, Chris. And the reason I like to start with this story whenever we talk about investments is to talk about the difference between skill and luck. When Chuck and I were playing basketball, Chris, could he have let me win?
Oh, yeah, he could have.
Yeah.
And he probably took it easy on him.
He did.
Yeah.
But that's because basketball is a game of skill. All right. And because basketball is a game of skill, you could intentionally lose a game of basketball. But what if when I walked into that gym, instead of picking up a basketball and playing with Charles, I said, hey, I've got a quarter in my pocket. Let's play a game of chance. And we're going to flip it. You pick heads or tails. Could Charles have then purposely lost the game?
Not at all.
Not at all, because that is a game of luck, a game of chance. Predicting does not take skill. It's luck. Most predictions are nothing but luck. For example, every year, Barron's puts out their top predictions for the year. And if you go out at the end of the year, and I'm saving this year to prove a point to some folks, you will find that most of the predictions, if not all the predictions, are wrong. So I don't like to get into the business of predicting because that is just luck. What we do,
Jay,
though,
I'm getting stuck on the story. So you and Charles Barkley going toe-to-toe in a game of 21. And did you get a rebound in that?
No. If I recall, and we played to 11, and I think I made like 2 shots, and he was just basically warming up before practice.
That's
so.
Great.
Yeah.
That is great. That is great. And I appreciate you telling the story and the honesty that you tell it. I heard someone tell a story once talking about playing touch football against Jerry Rice, good old Mississippi boy there. And they talked about how they could cover him. And I thought, no, you couldn't. If you would have played in the NFL, if you could cover Jerry Rice in a game of touch football. But anyway, but skill and luck. And so what, because you and I've seen the stats. I'm like you, I can't remember the stat on this, but it's something 90% plus of forecasts are wrong. And they're not a little bit wrong. They're way wrong. And so playing a game of skill versus playing a game of luck, when you're looking at the markets, how should we investors, let's start with how should advisors prepare to look at the world in 2022?
Yeah, so it is clear that you cannot predict the future, in my opinion. And I find most people find that to be the case, especially after they get it wrong for a few years. But what you can do is pay really close attention to things that are real, such as data, trends, and then build systems around that. So as I look at 2022, I look at some of the data and trends that could have an impact on the year that are already present. For example, market volatility. Inflation seems like it has the potential to be a real problem. And now oil prices, as we see predictions of it hitting into triple digits, which of course we don't know if they're going to come true or not, but we do know we're looking at oil here in the mid 80s, and that is a problem.
Okay. So expand on it. I mean, because that quite frankly sounds like the headlines that a lot of clients get worried about. A lot of people just see of course, politics dominates the headlines these days, but oil prices and inflation. You know, we talked last in the fall, about transitory inflation. As someone is looking at that, so that how do they get the fear out of them and actually see the headlines, see the news, and do something with this information besides just pay more at the pump?
So if you're asking from the investor's perspective, ideally, when you see a headline, you should not be making changes in a portfolio. You're building a portfolio based on a set of rules, and those rules change based upon the predefined, back-tested rules in the portfolio, not because a headline pops up here or there. But in terms of looking at 2022 overall, as we sit here at the beginning of the year, those are some of the trends that are definitely worth paying attention to. But those changes in the portfolio should have already happened based upon the set of rules you have for running your business.
Yeah, are you trying to move in front of the markets or trying to move behind the markets based on those rules. And I like taking it right back to rules, because you can do the same things in a financial plan. So you've got a plan, whether you're preparing for retirement or you're in retirement, you're preparing for college planning, or you're preparing for some other goal, some other dream, some other objective that you want to achieve. Go back to sticking with that plan. I find that that's the biggest challenge, that people get derailed with the headlines and the fear that comes from the headlines, that they start worrying about, or oil price is going to derail my financial plan. The answer to that question should be absolutely not. You're just going to pay more at the pump, but it's not that egregious if you've planned well. And then there's a place in a plan, kind of typically in those early stages of a plan, that, yeah, I can kind of derail you and it get expensive, especially if you have a job that causes you to drop a lot, things like that. But, rules-based investing and rules-based financial planning, it gives you that solid foundation to come back to when something outside of your control or influence is derailing you.
That's right.
So,
Chris, it gives you the only map for success, the only map for not failing your finances in retirement when you can least afford it. I had a PR rep once say, they reached out and they said, "Hey, we watched a lot of your shows. We think you should probably try and pivot to Bloomberg and CNBC and try and get media appearances." And I said, "I would be an awful guest on those shows. I'm incredibly boring. I say the same thing over and over and over again." And it gets down, Chris, to, I'm sorry?
Go ahead. No, you're right on. I love this. Yeah.
I don't say anything exciting. Investing gets down to 4 simple rules, Chris, and I'm going to lay them out for you. Number 1, investors should not pay more in fees than necessary. Number 2, investors should not pay more in taxes than necessary. Number 3, investors should not underperform their benchmark. And number 4, to be successful, investors should not make poor investment decisions during periods of market duress. And Chris, the reason I know that these 4 rules are absolute, let's take the inverse of those and think through what would happen. What if investors made poor decisions during market duress, like pulling all their money out of the market at the bottom in 2008 or 2020? What if they underperform their benchmark? What if you pay too much in taxes? And what if you pay a bunch of high fees? Are you going to win retirement? Absolutely not.
So let's take those 4, because I'm going to go back to something you said just a second ago, that because I've had friends, you and I both had friends that are on Bloomberg or CNBC or Fox or whatever the case may be. And I every one of them have told that they have an earpiece in, and you have a producer in the show directing the arguments within the show. And that if you don't argue enough, if you don't have a strong enough opinion about something, if you're not emotional in how you share it, then you're not invited back on the show. Has that been your experience?
What 100%? Actually, I have producers tell me that.
Yes.
You have to be
the danger of that is, and this is what I want the listeners to hear you and I both saying here, that if you're making decisions or you're putting pressure on your advisor based on what you're seeing on those shows, it is an emotional driven show by design. Those shows' job is to make money for the company by selling ads, not to deliver the news. And I'm like you. I stopped listening to those shows in the summer of 2008. And up until the end of my career, but in the summer of 2008, with what was going on in the 2008 markets, what was going on in what we thought was a nasty presidential election at the time, I stopped listening because it was just emotionally wasn't healthy for me to do. And I finally learned a lot of it was nonsense. And so I have no idea what they sell on these shows now. I haven't watched in, gosh, that's 13 and a half years ago. So
you and your clients are better off for it.
You don't get that drive in. How many advisors have you seen on that drive into work? They hear something on Bloomberg and, oh my goodness, we got to go sell small caps,
right?
Because it's something they heard on a news show.
Or Chris, the image of the financial advisor sitting at their desk and there's 8 monitors blinking everywhere, what different markets are doing, where stocks are trading, and somehow they're going to outsmart the smartest people and the smartest computers in the world. It's absolute nonsense.
Well, and it's the collective thought that goes into the markets that you're not going to outsmart. I mean, does Ray Dalio try to outsmart the markets? And anything you've read about Ray Dalio, has he ever attempted to try to outsmart? Does Warren Buffett try to outsmart the markets? No. He might beat them in one trade. Yeah, You can go find one good company, but he's not even trying to beat the market. I think this is what we find is that's not their benchmark. So let's talk about your 4 rules. Start unpacking these, and I'm gonna go straight to the benchmark one because that one I find that word creates more havoc in people's financial plans than anything else. So
Yep.
instead of me debating you and teeing off on that one, all right, why don't you explain more what you mean?
Yeah, so these 4 rules are incredibly simple by design. Anybody watching the show was able to understand those 4 rules because of their simplicity, and that really is by design. The one I get the most pushback on from financial advisors when we first start talking about using this rule set is the benchmark. And the reason is most people, when they hear benchmark, they think of terms like the S&P 500 or the bond aggregate index. And they're trying to think about building a portfolio that beats that because their clients are watching CNBC, reading the Wall Street Journal, and trying to determine if their portfolios are beating that benchmark. But Chris, that's not what I mean by benchmark. You don't care what the S&P 500 is doing 25 years from now when you're in retirement and you're trying to live off your nest egg. You only care what your personal benchmark does in 2022 and 2032. So working with a financial advisor to determine what that benchmark should be is very, very personal. No two people have the same benchmark because everybody has different goals, everybody has different starting points, and different tolerances for risks over market cycles. So the reason it's one of the 4 rules is you have to determine what that personal benchmark is for you and then manage your finances towards it.
So is it basically your goals? What are you trying to achieve? What is your basic standard that you're trying to achieve? Or would you define it some way else, in some other way?
Well, so let's turn it into a financial planning conversation because that truly is how financial advisors serve their clients and say you're saving for a college education. Well, that's fairly easy to benchmark. You can go out and find data on how much college inflation is today and where you think your child might want to go. And that's easy to determine what that benchmark would be. The more challenging question is retirement. How much money you're going to need in retirement? And more importantly, this is the key, how much income are you going to need in retirement? How far out are you from retirement to go and grow that personal benchmark? And then the mathematical equation to go and make all that work. That should all factor in to that part of the process so that when the client is upset about an election, the client is upset about oil prices or whether Putin's going to go invade another country, it doesn't matter as long as you're still managing towards your personal benchmark.
Jay, I think that you and I've talked about this so many times. This is where our topics go boring, but this is what's very effective. You and I talked about this last week or so in looking at 22 and looking at a podcast schedule, that the sexy topics are investment strategies. So if we talk about trend following, we talk about stop losses, we talk about rotation to manage risk. If we talk about using credit spreads to predict stock futures and trading options on that, it becomes a very cool topic that people will listen to. Hey, look at the meme stocks last year. Those were all pumped up by emotion. But you and I've said this before, emotion runs out, emotion will fail you. Your planning is what carries the day. So if you're a grown-up, mature investor, listen up, pay attention. Okay. If you want to have a fun account where you're doing some crazy trading, fine. I know a lot of people that do that, but they intentionally hire an advisor and go through a financial planning process with them. I can't tell you how many times I've been told that, but typically men want to have, I'm keeping this amount of money on the side and I'm going to invest it. That's the control freak in us coming out. That's the adrenaline junkie in us coming out. And that's the gambler coming out. And if we want to go shoot dice in the corner, okay, if you just got to go do that, I totally get it. We can have some really cool, sexy stories when we talk about different types of trades. All right. But honestly, I tell our listeners, Jay, I think you and I would actually make those topics boring as well, because it would get very practical and very efficient and call for a lot of self-discipline. I think time and again, I've heard a lot of the traders that I've read about basically have 3 simple rules. Number 1, manage risk. Number 2, let your winners run. And number 3, manage your emotions, period. Same thing can be said in financial planning. Number one, manage risk. Number two, follow your plan. And number three, manage your emotions. I'd only change the second rule. Yeah, following your plan. And so let's talk about some of those others. So we're going behavior, benchmarks, taxes, and fees. And so because taxes, when does that, at what point, yeah, it's kind of hard to come up with even a line in this, but where's that kind of conversation a little bit too much sugar for a dime? I've seen a lot of people, not worry about taxes that should. I've seen a lot of people worry about taxes that really shouldn't. Do you have any advice on that? I mean, how can a listener gauge, should I pay attention to this or not?
Yeah, so that's one of the benefits of working with a financial advisor and a good CPA. So the way you can get the most lift in your portfolio is making sure that your finances are tax optimized. Why pay more in taxes than you should? And so if you look at trends, not predictions, but trends, the trend line for taxes is really only going up. So going forward, it's incredibly important.
What he means is that for eons, it's been predicted that it cannot go down any further.
That's right.
It's only got one direction, unless modern monetary theory comes true, Jay.
Yes.
That's a totally nerd out conversation. That was intentionally a nerd pitch there. All right. Yes. So taxes. I'm sorry. Yeah. I'm interrupting you.
No, but taxes are hard. Taxes are boring. But if you pay attention to it, you work with an advisor to make sure you're maximizing your tax strategy, that can really have a significant impact on your finances over the long term, and you just can't avoid it.
Right. And I found this to be true, though. I would say talk with your CPA. If taxes are an issue to you, you need to be working with a CPA in this. And I'm saying this now as an advisor, because tax optimized plans, they sell really good. They sound really cool. It has a lot of sizzle to it to make you feel like you're doing a lot of good for yourself. And I've talked to a lot of CPAs, Jay, through the years that have said, Chris, just make the client money and I'll take care of the taxes. And so that was a CPA and I working together on the client's behalf. And I think that's key, because there are clients that we do use really pay attention to tax optimization, because you could walk yourself into some serious cash outlay at the end of the year if you're not. And so I think it's got to go. I'm saying this now as an advisor, that you got to work with the CPA in conjunction with. I think that's very important.
And Chris, if I could just add, because this is important, there are structures out there now that help you mitigate some of your taxes. Now, obviously, there's the tax deferred accounts like IRAs that, that's table stakes for any advisor to use. Yeah. But trading structures such as exchange traded funds are set up in a way so that changes can be made inside the ETF that are done in a tax-friendly way for the taxable investor. Yeah. So leveraging that for strategies that have higher turnover can, over the long term, add to your wealth over time.
Mm-hmm. And that sets up something that you mentioned fees as one of your 4 rules, because I really want to park on behavior, but I'll say this in ETFs. When you're saying this about, when you're saying pay less and don't pay any more than your fees than you need to, I would also add to understand the fees that you're paying. Have a conversation with your advisor that says, explain this to me, so that you can get a true comparison, true understanding of what you're paying, a true comparison with the industry, because our industry is notorious for hiding fees. That's something that sounded we did. We pushed all of our fees very transparently, on average, right there in line with the rest of the industry, but ours are very transparent. So, because when you make that comment about an ETF, there's a particular ETF that we use that a lot of the trading is done inside of it, because it gives it optimizes the trades for tax purposes, but that position's a little more expensive because there's work going on inside of the position. So all fees are not created equal. What are you getting? If you're just getting a position that is a plain vanilla chocolate position, it's pretty simple, fees should go lower. But if you're paying for a complex position, be sure that you're getting what you're paying for. I think that goes both ways. We can unpack that for a while. But let's go to behavior. Okay. When you say one of your 4 rules, because this is probably one of my favorite topics, and one that we're going to sit on for weeks to come, you and I are. But let's kind of tease that a little bit. what do you talk to people about their behavior, their financial behavior?
In 2008, 2009, when people's finances had been decimated, some of them for the second time in a decade because they had gotten blown up by the internet bubble, there was this mass swell of folks pulling money out of the markets because they were scared. They didn't know the unknowable future. I am of the belief that those folks did not have a good financial plan in place. They did not have that money allocated from a time segment standpoint for when they were going to need it. And so they weren't able to weather the storm. They got out of the market at the wrong time and the markets went back up. Now, back in 2020, when we had extreme market duress for a very short period of time, there was a lot of that same type of overreaction, and most folks did not get back into the market in time. They were trying to time and guess the markets in order to protect their finances or grow their finances, and it led to really, really bad outcomes. So, Chris, it's human nature to be scared and take that type of action that you feel like you're protecting yourself. But at the end of the day, when it comes to investing, you just end up hurting yourself. I don't have the industry data, but I'm fairly confident that most folks who were not working with advisors and planners made some of the poorest decisions during that time period. And unfortunately, for some people, if you're over a certain age and you make a poor decision like that, it will ruin your finances through your retirement. So, more important of the 4 rules, this is the most important rule. You cannot make decisions with your money based upon emotions. It needs to be based upon facts and your actual financial plan.
And there's so much that goes into this. So you're talking about a scenario. Let's just take the spring of 2020. Only nerds that were been in the industry a long time, like you and I, remember 08 and 09. Everybody kind of crams that. If you found that to be true, that everybody or a lot of investors just kind of cram that into the tech wreck. It's just the Great Recession and the tech wreck. Sometime way back there 10 or 15 years ago. But I call you and I nerds affectionately. So, but everybody remembers the spring of 20, the COVID market where it sold off about 38% in 3 weeks. And there's a fear that people, they run to safety on the downside. And what we're talking about, you run to safety on the downside and then you miss the upswing. But in what scenarios should somebody, let's play a little game here. So let me be devil's advocate. What scenarios should somebody have gone to safety, gone risk off and gone to safety?
Yeah. So prior to the period of duress, if there was a set of rules in place that drove a portion of the portfolio or all the portfolio, if it made sense, into a more defensive position or cash position, that would be acceptable as long as on the other side of that, there were a set of rules that got the investor back into the marketplace.
That's right.
And Chris, that is how I manage my own money or a portion of my money. And that enables me to have a level of comfort that, hey, I'm going to get out of the way of some train wrecks based on a set of rules that's not always going to be right. And then I'm going to be forced back in the market when that happens. But I want to be clear. I've made plenty of bad mistakes with my money over time. So I don't do that with all of my money. It's a portion of a diversified portfolio.
I think that's key that you just said a couple of things there. When you're saying you made mistakes, you're a professional, you've done this for over 20 years that I know of. And I think that is something that people hold on to, that they're failures when it comes to money and they never attempt success again, or it takes them years, maybe even a decade to attempt success again. I have found that to be one of the biggest detriments to the way we accept failures. A lot of athletes tend to go into business. They got kind of an entrepreneurial mindset. Do they have an it factor or a giftedness that other people don't have? I don't think so. Not at all. Not at all. I knew a lot of athletes. They weren't very intelligent in many cases. But you learn this in sports as a kid. You fail often and you just keep getting back up. And if you play baseball, you strike out, you get out a lot. Well, you just go back up to the plate next time, swing again. And I think a lot of investors miss out on that they expect perfection. Like you were going to time the market and get out and lose 0 in the spring of 20. and you were going to time the market and you were going to get back in somewhere around about negative 38 on the S&P and ride it back up, if that is your benchmark, you are setting yourself up for failure every single time. You're not going to succeed at that game at all. And you don't have to succeed about that game to succeed financially. I think that our behavior, the number one thing that I've seen in my career that wrecks financial plans are the investor's behavior. Number one, hands down, and I'm including lack of discipline in that. And it's a soapbox that we're going to get on, Jay. Are you ready? We're going to over the next couple of weeks, we're going to record these. And we're going to dive into all the fears, right? Fear of loss, fear of regret, fear of missing out, biases. Pick some of your favorites: confirmation, conservatism, self-attribution. What are some of their favorites? We'll have to dive in and come up with a list, okay? So,
hey, Chris, may I add something to what you just said? So I have found that there are a handful of folks that I really enjoy reading in this industry. So Ray Dalio is one of them. John Hussman, your chief investment strategist, Clint Sorensen, puts out great research on trend following. And he always talks about the fat pitch. And for anybody who knows anything about baseball, you want to hit the fat of the baseball right at the right time when it's over the plate. And so you're never going to go and sell at the bottom. You're never going to get out at the top. You want to capture the returns that are right there in the middle. And you and your team do a good job of explaining that. And that's the key for that portion of a portfolio, Chris.
Absolutely. And the emotions that go behind this. So give you the last word. What are you most excited about in 2022?
Chris, for me personally, I'm most excited about a broadcast network that we're launching through Resilient Advisor called Financial Advisor TV, where we're an advisor education company where we're going out and sourcing the best industry resources for financial advisors to learn in a modern day format of video first, short form education, just to help educate advisors and help them better serve their clients.
That is awesome. I look forward to seeing all that content because I'll be one of the listeners, Jay. Jay Coulter, ladies and gentlemen, with the Resilient Advisor. Jay, my friend, thank you for joining us, buddy.
Thanks for having me.
Welcome back. Glad you stuck around and listened to us. And I hope that you got a lot out of that interview with Jay Coulter. He's a good friend. He's an excellent resource for us at Sound in the industry. He's just one of those guys. He's so well connected. I always love to hear what he has to say. And I think that you could get a lot of valuable insight on what you should do to think about your financial plans, your investments, and prepare in 2022. And this is going to be a big theme for us. When you look at the markets, especially in this month in January, they're volatile. And you see these headlines of cryptos going down and oil prices going up and inflation's going up and interest rates are going up, and are central banks going to control the economy, or is whatever variant we're going to have this year going to control the markets in the economy? And you know what? You cannot control any of it. You're not in charge of any of it. You can't even influence what's going on. But you can control the economy in your house. And that means that you can have a good financial plan. You can stick with your financial plan. It just takes discipline and thought process on your part. And so I highly encourage you, lean into what are your goals? What are your objectives? What are the steps you're going to take to reach those goals and objectives? Because an excellent plan and the discipline to stick to it will carry you much further than all the cool and sexy talk we could ever come up with talking about the markets, okay? But if you do couple it with excellent returns, now you have something special. That's the secret sauce. Great recipe right there of excellent planning, discipline, and good returns. But let me share this verse. This verse comes out of the book of Proverbs, chapter 21, verse 31. It says, "The horse is prepared for the day of battle, but victory belongs to the Lord." I thought of this verse as we were preparing for this podcast. That verse in particular was I called it my game verse when I was a kid, when I was playing ball. It comes from no place of godliness whatsoever. I was a bad kid. I had a really misfit youth, but it was a big time superstition. Because I had this idea, this thought, and this is so true. This is exactly what this is saying, that you can prepare for life all you want to. But if you just think for a minute, how much is out of your control in life? How much is out of your influence? Don't let that scare you. It's just life. But how much of that is under God's control? All of it. How much is under his influence? All of it. Okay. And without diving into why bad things happen and all that, which I'd love to have that conversation, but that's a big, long podcast in and of itself. You prepare well, prepare with excellence, use the resources and the opportunities that God has given you, but put your trust and confidence in Christ. Okay. Find your identity in Christ, not your failures, not your successes. And so then you can roll through failures and roll through successes, and neither one of them define you. So as we talked about earlier in the show, you keep getting back up at bat, okay? Or you keep getting off the mat when you get knocked down. Your failures don't keep you pinned for decades, all right? But your successes don't make you arrogant, and they don't create an entitlement in you. And that's what I want for you. I want successes. I want you to reach your goals, reach your dreams, do big, good work, do cool stuff, all right? Serve people, love God. A lot of the things we talk about on the show, all of it for your good and for God's glory, okay? But don't find your identity in the end of it. Find your identity in Christ. And as you wrap that up into financial planning, then money just becomes a tool. Planning just becomes actions that you take. And you can buy into it a lot further because you don't wrap up your emotions in it quite so heavily. And hey, listen, this is hard, right? This is hard for me. I'm a very emotional person. Ask everybody right here at Sound. I can go up and down and sideways in a heartbeat, okay? But I've simply found, whether it's in financial planning and that's personal, or business planning when it comes to the chase or it comes to sound, that if you can keep a little bit of emotional self-control, then you can be yourself. I'm not saying don't be yourself, but you look at the facts as they are. Recognize your fears, recognize your biases as they are, okay? Accept them. This is part of your personality, but you grow as a person, okay? Don't just say, hey, that's who I am and do nothing about it. But have the self-discipline to plan well, take good steps, okay? And follow through with your plan. And when you get knocked down, you get back up. And this is what we want to talk with your advisor here at Sound. Is for those of y'all that are clients of ours already, talk with us about this. I love this conversation because it is for your best good, all right? I say this a lot, all while you're chasing success, all while you're chasing status or security, all we're trying to create and build and grow good things. And these are a lot of good things that God has designed us to do, okay? But remember this, all while you're chasing good, God is chasing you with something great. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.